Welcome to Unrivaled Investing. My name is Daniel. Regular viewers know I love to find instances, situations where there's good alignment. Maybe there's huge insider buying or management owns a ton of stock. It increases the odds, in my opinion, of a favorable outcome. And that's why earlier this week, I ran AI Ticker Chat's new stock scanner for insider purchases that occurred in the past month for over $10 million purchases. Here's a list of the different companies. You can see that here. Let's go into it because I think there's actually three different interesting ideas for investors to consider. Once again, this was from Leveraging AI Ticker Chat. The first is actually Zillow, where you can see Jay Hogg from the technology crossover ventures firm made a $100 million purchase of Zillow shares, around $43 per share. You can see all this insider transaction information also at AR Ticker Chat. And I was skeptical at first, in all honesty, to look at Zillow because the broader macro perspective in terms of U.S. housing is not favorable, with U.S. pending homes, reaching a 4-year low as interest rates, are a new normal, much higher than they previously were versus the previous zero interest rate environment. But as I looked at Zillow's results, I'm looking at revenue growth of 13%. Underneath that, though, I honestly expected a revenue decline figure. Underneath that 13% growth figure, there are some fast moving pieces. Their rental business is growing 31%. That's a $100 million business on a quarterly basis. Their mortgage business is up 19%. And their mortgage origination business or mortgage origination volume was up more than 130%. So there's something really, I'd say there's something interesting going on here in terms of the traction. And management makes a whole separate case for why they think rentals can be a much bigger business, because look, they already dominate in terms of the home sale market, where they pretty much get nearly all listings on Zillow. But in terms of rentals, they're still just tapping into a sort of a fraction of the total, 60% of long tail properties, 35% of multifamily units. And so, they think there's a lot more market share for them to grab over time. And ultimately, they've been growing this, at a fast clip for a couple of years now. And they think that 2024 is a year to scale up the breadth and depth of their rentals business. They think this is $1 billion plus revenue opportunity versus, generating, let's say, $100 million in the most recent quarter. So this is quite interesting because, this is sort of like thinking about the old, newspaper ads that used to be super high margins for the newspaper business. There's no reason this shouldn't be extremely profitable for Zillow long term if you believe they can get this market share and keep growing. Growing at 30% suggests they're doing something right. So I like to see this. This could become a real cash cow for them. And they're leveraging their dominant brand and search position, where they call out how Zillow is searched more on Google than the category term real estate. 80% of our traffic is organic. So that means they're not paying for people to go. It's people effectively saying, oh, I know the brand, I trust it. They're talking about their app usage is 3 times that of anyone else in the category. So this is a really strong brand position. Would not surprise me if these other initiatives, rent, mortgage, that they figure out ways to make this business really profitable over time. Honestly, a little surprising that they haven't yet. If you look at their GAAP results, they still reflect, I'd argue, a lack of serious cost discipline. And this is a little surprising, a little disappointing, because you do have one of the founders, I think co-founders, still running the business. CEO, I think it's Rich Barton. And, they do have favorable adjusted EBITDA to the tune of, let's say, $500 million per year. But overall, looking at it, I would expect for a business of this caliber, where you have this dominant brand, to just be incredible, generate real profitability, not just stock-based adjusted, profitability. Now, the free cash flow is starting to, build up there, and they do have a sizable cash balance. But I overall look at this and say, okay, there's a real chance that this, I can understand the reason for putting why a smart investor might put in tens of millions of dollars into Zillow, because if they truly do capture rentals, and it looks like they might, maybe that's generating, a $500 million to $1 billion in profits for them long term versus a market cap that's only around $10 billion, subtract a couple $1 billion in net cash. And you could see how this could get a much, much higher multiple. So Zillow's one that's interesting, maybe worth reviewing further in the future. I just don't like the lack of cost discipline that they've historically shown. And also, that there were some missteps previously on the home buying initiatives. Okay, what's the second idea from looking at the massive insider buying? The second is actually Salesforce. I previously called out Salesforce as sort of mismanaged, with incredible stock-based compensation, a whole separate other video. But in this case, you are seeing a $100 million purchase from Value Act. I don't like to see this mixed picture, however, because even though Value Act's buying $100 million, I'd argue you have insider sales from founder Mark Benioff, selling like $3 million with every day that ends in Y, it feels like, looking at this. So, it's not, this isn't a particularly attractive insider sale to purchase ratio, I would say, but it is interesting to suggest, one smart investor is stepping up to the table and saying, what, I'm going to buy now. And maybe the reason why is because he's looking at the valuation for Salesforce, and it's never been lower on a free cash flow basis. It's currently trading around 20 times free cash flow, and management's guiding to single digit growth, much faster free cash flow growth. So that does suggest they're taking their expenses a little bit more seriously, getting their scale in terms of their costs. Their costs won't be growing as fast, and that's why their operating cash flow will be growing over 20%. So I do like to see this picture, but I do think there are two things that sort of give me pause as I think about Salesforce. One is, I made the comment about mismanagement. That's really just, I don't like to see billions of dollars of stock buyback and not really see the diluted share count drastically drop. It does sort of reflect you're running in place, and it does reflect that management internally doesn't really understand, like, to announce you're going to do billions of dollars of buybacks and then do billions of dollars of stock-based compensation to effectively go nowhere means the shareholders don't really get paid out. And you want to see the diluted share count go down each year in order to say, oh, okay, the buybacks are actually meaningful here. There are some companies where they say, hey, if you want to, own part of the company, you need to buy it, and we'll give you a bonus to buy shares. That's a much more shareholder friendly policy, in my opinion, which is, hey, here's a bonus and you have to use it. You have to allocate that bonus to buy shares. I think that's just much more aligned than this sort of, moving the cups around to suggest, oh, there's tremendous value creation, yet the share count doesn't change. I also, to be honest, looking at their guidance, I think it is worth, if I wanted to dig further into Salesforce, which frankly I don't, but if I either owned it or were more interested, I'd want to explore how some of their competitors, how fast they're growing, because for them to talk about 8 to 9% growth, I know HubSpot targeting smaller CRM, customer relationship management software, they're growing much faster and are expected to be growing faster in the years ahead. So I think that is a bit of a red flag that I think investors need to be mindful of, is that, yes, Salesforce is no longer just CRM software, but you do have sort of the barbarians at the gate that are looking to get in and sort of nibble away at your market share. So I think that is important for investors to reflect on. And perhaps that's why it is at this valuation. What's the third idea? First, quick break. In full disclosure, this is not financial advice. Also, quick plug, earlier this week, I think just 2 days ago, on our exclusive Discord server, a premium member wrote, this is a direct quote, "First of all, I would like to thank you for all the knowledge that you share with us. You have helped me a lot in my investing journey. I've managed to turn £3,000 to £500,000 in 4 years with a regular salary. That really makes my heart sing." That's what this is all about, helping people on their different investment journeys. Obviously, having a salary certainly will help you, but my goal is that by sharing my own personal investment journey, sharing a weekly letter, sharing a monthly video, that can help people sort of inspire them for their own journey. Maybe it works out, maybe it doesn't, but my goal is that maybe it leads to some favorable inspiration for different subscribers. In this case, it did. So if you're looking for compelling investment ideas, come check out Unrivaled Investing. And so let's look at the third idea. The third idea is really a basket, because You see in one instance, Warren Buffett recently spent 9 straight days purchasing Occidental shares. And full disclosure, I do own stake. I do own shares in Occidental as well. Not nearly the 30% stake that Berkshire Hathaway has. So it's interesting to see Buffett keep buying this. And you might say, well, Daniel, geez, I don't have any interest in oil, but maybe that's the point of this third idea, is to make you think about it, because he's not the only one with sizable insider purchases in the energy space. You have Talos Energy. This is another company in the past month, insiders making a $20 million investment. This is an independent oil and gas company, United States, Gulf of Mexico, and offshore Mexico. That's where they're producing. You see another oil-related company, this time ProFrac Holdings. An insider spent $22 million. In this case, it's about providing fracturing service, so the fracking to effectively help drill that oil. So one is you own the oil services. So this is the part that's super interesting to me. You see the mega oil company, the like billion barrels a day type of thing, from Occidental. Then you have Talos, which is a much smaller play, oil and gas play. Then you have a fracking company that's not, but it's benefiting from the demand for oil. Then you have a third play. This isn't directly related. This is now downstream. This is PBF Energy. This is one of the largest independent petroleum refiners in the United States, making a $75 million. I think a Mexican company is investing, is over a 10% holder in PBF. So there's an interesting dynamic here, because you have the fracking, you have the ownership of the wells, you have the refining, and no matter where you are sort of in the oil life cycle, you have investors saying now is a great time to purchase. And then you have one of the GOATs, the greatest of all time, Warren Buffett, keep showing up day after day to buy. And he's made it clear he's not looking to, at least he's written this. It's important signaling that he's not looking to control the company. Maybe he wants to do that so he keeps the premium as low as possible. But it's just super interesting to see these insider purchases. I mean, in my opinion, it's a signal. When you go, okay, who's been making the big bets in this past month, where they're insiders buying over $10 million of a given position, either directors, 10% plus owners. And you see that energy, whether or not it's fracking, downstream, or the actual oil asset, is disproportionate in terms of that. It does make me think like, maybe I need to sharpen my pencil. And I just personally, there's a hurdle for me in terms of getting over that. I just don't like commodity companies. I would rather have something where, you have that pricing power each year. There's something special. You're an unrivaled, not a commodity type of business. But maybe, Buffett's looking at the deficit spending. He's looking at 2 different presidential candidates and thinking, one's going to have really big deficits and the other's going to have even bigger deficits. And, in that environment, you can print a lot more dollars, but the rate in which you can increase the supply of oil is not going to change dramatically. In which case the price of oil in those dollars could be going up a lot in the future. So I suspect that is one of the elements that he's thinking about. Maybe it's, Mike, another concern is, what if there's a recession? Aren't oil plays going to get a really, hit on the chin in that type of environment? Because you see the demand contraction, quickly, in terms of the industry. So I look at that and isn't he aware of the economic cycle and where we are, or does he just not care? And he's thinking 5-10 years down the line, oil prices will likely be higher just because of the deficit spending. I'm not sure. Maybe it's just his decade-year track record where he's, he lived through the 70s. He's like, oh, this is just going to go higher based on the profligate spending. I'm not sure. If you have a different perspective on terms of these three different ideas, talking about Zillow, Salesforce, and oil generally, if you have a favorite oil play, would absolutely love to hear a write-up or thesis in the comments below. And if you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button. Thanks so much for watching Unrivaled Investing.